Hello, all. Welcome back to the channel. There are over 100 ETFs in India, all claiming to be the best way to grow your wealth. But which one should you pick? The problem no one talks about. You see big names like Nifty 50 ETFs, Sensex ETFs, Gold ETFs, and even international ETFs. But what if I told you that most people end up picking the wrong ETF, paying higher fees and getting lesser returns than they should? If you are investing in ETF or thinking about it, this video will be the most important guide you will ever watch because I will break down everything you need to know in the simplest way possible. By the end of this video, you will know exactly which ETFs suit your goals, how to analyze them, and how to avoid common traps that hurt your returns in the longer runs. The Indian ETF market is still young, but it's growing fast. And while most people stick to the Nifty 50 ETF, the real smart investor look beyond just one option. And by the end of this video, you will know how ETFs actually work, what is the difference between active and passive ETFs, the number one factor that predicts ETF success, the best ETF in India for beginners, and hidden costs that can eat your profits. First of all, what is an ETF? Think of an ETF like a basket of stock. Instead of buying individual stocks, an ETF lets you buy a group of them all at once, just like picking up a basket of groceries instead of buying each fruit separately. Let's take an example. If you invest in a Nifty 50 ETF, you are buying small portions of all 50 companies in the Nifty 50 index, like TCS, HDFC Bank, Reliance, Infosys, and so on. You are not picking one stock, like you are not picking TCS only. You are picking all the top 50 companies based on their weighted index. Instead of picking just one stock and hoping it performs well, you are diversifying your risk and investing in different sectors. So, if you have simply invested in the Nifty 50 ETF in 2010, your money would have more than tripled by now without having to pick a single stock yourself and thinking it should have been gone up. But here's the important part. Not all ETFs are good investments. Some have higher fees, some have low liquidity, and some don't even track their index properly. When you invest in an ETF, the expense ratio isn't the only cost you pay. There are hidden costs that can quietly eat away your returns. And if you ignore them, you could end up paying way more than you expected. Let's break down all the expenses which you have to think about before investing in an ETF. Number one is tracking error. You invest in an ETF expecting it to mirror an index. But sometimes, due to management inefficiencies, the returns don't perfectly match. If the index grows by 12% and your ETF only grows by 11.5%, that's 0.5% is a silent loss, and that is nothing but tracking error. Number two is bid ask spread. When you buy an ETF, you don't always get the exact market price. There is a tiny gap between the price at which you buy and the price at which you can sell. For highly liquid ETFs like Nifty 50 ETFs, this spread is very tiny. But for smaller, less popular ETFs, the difference can be significant. Number three, rebalancing cost. ETFs adjust their holdings when an index changes. This results in buying and selling cost, which can impact your returns. So how do you avoid these common mistakes? Number one is stick to ETFs with low tracking errors. Compare historical returns of the ETF versus its benchmark before investing. Number two, pick ETFs with high trading volumes to minimize the bid-ask spreads. The more liquid the ETF, the lower your buying and selling costs. Number three, choose ETFs with simple strategies. The more complex the ETF, the higher the rebalancing cost. Now that you know that what are the fees to watch out for, let's talk about how ETFs actually make money for you. ETFs helps you to build wealth in three main ways. Number one is the capital appreciation. Just like stocks, ETFs grow in value over time. If you invest in a Nifty 50 ETF today and the index grows over the years, your ETF price increases. This is the long-term growth strategy. Number two, dividends. Some ETFs pays regular dividends, just like stocks. For example, if you invest in a dividend yield ETF, you get paid a portion of the profits that companies distribute. This is a great option if you want a passive income stream. Number three, risk diversification. The biggest advantage of ETFs is that they spread your money across multiple stocks. Instead of putting all your money in one company, you get exposure to dozens or even hundreds of companies. This lowers your risk. The best part, you can mix and match these strategies. If you are young and want high growth, go for Nifty 50 or Nifty Next 50. If you want stability, look for debt or gold ETFs. If you want passive income, pick dividend ETFs. Or you can mix and match all these strategies based on your risk profile. Now, by choosing the right ETFs, you can tailor your investment strategy to match your goals. But how do you actually buy these ETFs? Let's break it down step by step. Investing in ETFs in India is easier than you think. Here's the step-by-step guide to get started. First of all, you will open a demat and trading account. You need an account with brokers like Zerodha, Grow, Upstocks, or any major stockbroker. If you already have one, great. If not, it takes just a few minutes to set up online. Choose your ETFs. This is where most people get stuck. Here's the simple rule. For beginners, start with Nifty 50 ETFs. For higher growth, try Nifty Next 50s. For stability, consider gold ETFs or debt ETFs. Number 3. Place your order. Just like stocks, you can buy ETFs directly on the NSE or BSE. Search for the ETF name, enter the quantity and place your buy order. Track and hold. The beauty of ETF is that they require minimal maintenance. Just hold them long term. Check your portfolio occasionally and let the market do its job. Now that you know how to invest in ETFs, let's talk about building a solid portfolio. If you randomly buy ETFs without a strategy, you might end up with an imbalanced portfolio that doesn't perform well. Instead, here's a simple ETF portfolio strategy that works for the most investors. The core satellite approach. It is best for the long-term investors. Think of your portfolio like a tree, where the trunk, that is core ETFs, are the broad market ETFs like Nifty 50 or S&P 500 ETFs, which form the base of your portfolio. And the branches, that is called as satellite ETFs, these are specialized ETFs like Nifty Next 50, sectoral ETFs like IT, banking or gold ETF, which add growth and diversification. Number 2, the 60-40 strategy, that is balanced investing, where 60% of your investment goes to equity ETFs like Nifty 50, Nifty Next 50 or S&P 500 ETFs, and 40% goes in defensive ETFs like gold ETFs, debt ETFs or dividend ETFs. This strategy helps balance growth and safety, ensuring steady wealth creation. Number 3, the aggressive strategy. That is for the high growth seekers and who have a timeline of 10 to 15 years, where you invest 80% in the growth ETFs like Nifty Next 50 or US ETFs like WU or VTI, and 20% in safety nets like gold ETFs or government bond ETFs. The key is to pick the right mix based on your risk tolerance and goals. Now that you have your ETF portfolio, how do you make sure it keeps working for you? That's where the next step comes in. Most investors set and forget their investments, but over time your portfolio can become unbalanced. For example, if stocks perform well, your equity allocation may grow from 60 to 75%, increasing your risk. And if gold price surge, your gold ETF allocation might go beyond your desired 10%. This imbalance can increase risk or reduce potential gains. The solution is that you have to do rebalancing. For rebalancing, first you have to review your portfolio once a year. Check if any asset has drifted too far from your target allocation. Number 2, sell the overweight assets. If equities are now 75% instead of 60%, that is your target allocation, sell some and move it to the bonds or ETFs. And number 3, buy the underweight assets. If gold fall below 10%, use the excess cash to buy more gold ETFs. Study says that the rebalancing once a year can increase your long-term returns by 1 to 2% per year while reducing the risk. That's the simple way to optimize your investment with minimal effort. Now that your portfolio is well balanced, let's talk about how to minimize the taxes and maximize your profits. One mistake many investors make is not optimizing their taxes. Even if your ETFs perform well, taxes can silently eat your returns. And here's how to legally reduce your tax burden. Long-term versus short-term taxation. If you sell ETFs within 1 year, you have to pay 20% short-term capital gain tax. If you hold your ETF more than 1 year, you have to pay 12.5% long-term capital gain tax above 1 lakh. That means you should hold your ETFs for long term to save your taxes. Number 2, use tax loss harvesting. If some ETFs in your portfolio are in loss, sell them before the financial year ends to offset gains from other ETFs. This reduces your total taxable amount. You can buy back the same ETF later if you want to hold it. For tax loss harvesting, I have already created a video in my channel. You can watch it to know more about it. So by using these tax strategies, you keep more of your money instead of giving it away in taxes. But now let's talk about a crucial factor. What happens when the market crashes? Stock market crashes are scary. But if you react emotionally, you might sell at the worst possible time. Here's how to stay calm and profit from market downtrends. Number 1. Don't panic and avoid selling in fear. Market crashes are normal. Nifty 50 has fallen 30-40% multiple times in history, but it always recovers. Selling in panic locks in losses. Instead, stay invested and ride out the storm. Number 2. Follow the buy more when others fear rule. The best time to buy ETF is when they are cheap. If the Nifty 50 ETF drops 20% to 30%, consider increasing your investment. Number 3. Having a SIP strategy in place. Investing regularly through systematic investment plan or SIPs ensure that you buy at both higher and lower prices, averaging your cost. During a crash, your SIP buys more units at lower prices, boosting your long-term returns. Number 4. Look at historical market recoveries. After the 2008 financial crisis, the market recovered within 2 to 3 years. After COVID-19 in 2020, the Nifty 50 bounced back 60% in just a year. Market crashes are not the end of your wealth. They are the best way to invest more. Smart ETF investors use market dips to their advantage. So, what actually we have learned in this video, let me summarize that. Investing in ETFs is one of the simplest, smartest and most effective ways to build wealth. You don't need to be a stock market expert or track daily price movements. All you need is number 1, a well-structured ETF portfolio. Whether you prefer the core satellite approach or the 60-40 strategy, having the right mix is a key. Number 2, the discipline to stay invested. The market will have ups and downs, but patience and consistency win in the long run. Number 3, the habit of rebalancing. A 10-minute check once a year can boost your returns and keep your portfolio aligned with your goals. Number 4, a tax efficient strategy. Keeping more of your profits by using tax loss harvesting and long-term investing makes a big difference. Number 5, the mindset to see crashes as opportunities. Instead of panicking, smart investors buy more when the prices are low. So, the earlier you start, the better it is. Even small investments in ETFs today can grow into massive wealth portfolio over the years. Now it's your turn. Comment below what's your favorite ETF strategy. And also like and subscribe if you found this guide useful. More powerful investing videos are coming soon.